green glare off the terminal, the red tick of the S&P futures, down 28 points. It's early, the coffee's already cold. Every timeline, every feed you open right now is screaming about the Middle East. US-Iran, stalemate. The headlines are deafening. But look at the tape. 0.5%, that's a rounding error. You're probably sitting there thinking the market is about to crater because of a weekend of geopolitical posturing. It isn't. Markets don't fear bad news. They fear what most people haven't noticed yet. We are hardwired to panic at loud noises, the flashing red banners on financial news networks. But institutional capital, the real money that actually moves this tape, doesn't trade on panic alerts. It trades on the plumbing. If you're staring at the geopolitical chessboard this morning, trying to guess the next strike, you're looking in the exact wrong direction. The real fracture isn't overseas. It's quiet. It's boring. It's happening right here underneath the surface of a market that everyone assumes is just waiting for a peace treaty to rip higher. Stop reacting to the sirens. Let's look at what the smart money is actually pricing in. Let's pull the raw data from the overnight session. Strip out the narrative. S&P 500 futures opened the week down roughly 0.5%. That's a 28 to 33 point drop on the board. Given the magnitude of the weekend news cycle, the volume is light. It's a mechanical adjustment. Crude oil is the active variable. WTI is trading at $102.74 right now. That's a bump of about $1.57, or 1.5%, pushing off a Friday close that pinned right on the $100 line. Look at the speed of that change. The climb since March has been steep and sustained. Precious metals are diverging. Gold is catching a fractional bid this morning. Last Friday was the pivot. It showed its first confirmed sign of behaving like a risk-off, safe haven asset again, after spending weeks tumbling in lockstep with equities. Silver's doing the opposite. It's trading slightly lower. It's behaving exactly like an industrial component tied to a slowing economy, tracking the broader weakness in risk assets. Then look at Bitcoin, flat across Thursday and Friday, hovering just below the $70,000 mark. But the underlying structure is entirely different from the rest of the board. Over the last couple of months, while the S&P gold and silver have printed lower lows and lower highs, Bitcoin has systematically carved out higher lows and higher highs. It is structurally disjointed from the broader market weakness right now. Under the hood, the macro foundation has already shifted. Confirmed banking data shows auto loan defaults and credit card delinquencies are spiking dramatically. Alongside that, February inflation metrics registered a quantifiable spike. Note the timeline. These consumer distress signals and inflation upticks were firmly in place before oil even began its current rally. That is the tape, no bias. Just the board as it sits right now. Look at crude. $100 a barrel isn't just a ticker symbol flashing green on a screen. It's a systemic, suffocating tax. The first order effect is obvious. You feel it when you fill your tank. But institutional capital doesn't care about your commute. They trade the second order effects. Margin compression. When oil rips from $70 to over $100 in a matter of weeks, every physical supply chain in the country eats that cost. Logistics, manufacturing, retail. Corporate boards have a choice: absorb the hit and destroy their quarterly profit margins, or pass the cost down the line. But here is the fracture point. They are trying to pass the bill to a consumer who is already bleeding out. We just looked at the confirmed banking data. Credit card defaults, auto loans going delinquent. People are maxing out 20% interest plastic just to maintain their baseline standard of living. And remember, that distress data was solidifying before oil went on this current run. You drop $100 crude onto a consumer base that is already drowning, and the math simply snaps. Discretionary spending dies. That's who gets hit first. This is exactly why the divergence in the metals market is a massive, flashing warning light. Silver is dragging lower. Why? Because silver is an industrial metal. It needs a functioning, expanding economy. If factories are pulling back because the end consumer isn't buying, industrial demand craters. Silver gets dumped. Gold, however, caught a confirmed bid on Friday. Smart money is rotating out of risk and moving into the bunker. They aren't hedging against a geopolitical headline. They are hedging against a fundamental breakdown in economic growth. Then you look at the equity market, the S&P 500. We've been floating on this euphoric AI narrative for months, but look at the perimeter. The memory chip stocks are already tumbling. The outer layers of the bubble are shedding. Why? Because ultimately, those massive tech valuations require a healthy spending economy to justify corporate ad budgets and enterprise software upgrades. If the consumer folds, the revenue misses cascade upward. This is the chain reaction. It's entirely mechanical. A sustained spike in energy prices forces inflation data higher. The February numbers already warned us this was happening. Sticky inflation means the cost of capital stays restrictive. You can't cut rates when oil is running. Restrictive capital breaks the leveraged consumer. A broken consumer cracks corporate earnings. If oil stays pegged at $100 for the next few months, the forecast model is blunt. We hit a recession by mid-year, a hard wall. If crude somehow retreats back to the $70 range, it doesn't fix the underlying rot. It just buys time. The timeline simply shifts to late 2026 or early 2027. Retail traders are just staring at the S&P futures, waiting for a green light to buy the dip. They're missing the termites in the floorboards. Dust off the archives. Pull up the daily chart of the S&P 500 and just zoom out. Strip away the noise of the last 48 hours. I've had this exact parallel channel drawn on my screen since the start of the year. Back in January, it was a lonely trade. The consensus was uniformly, aggressively bullish. The soft landing narrative was treated like gospel. Just close your eyes and buy the tech dip. But look at the structure we've built since then. We've been here before. Whenever you have a multi-year macroeconomic shift, the market leaves heavy footprints. What did we see at the top of this current channel? A pivot high, a quick violent pullback that convinced everyone the correction was already over. And then that slow, agonizing, rounded top. You need to understand what a rounded top actually represents in the real world. It's not just a shape on a screen, it is a transfer of risk. It is pure institutional distribution. Heavyweight funds quietly, methodically bleeding off their long exposure, feeding their bags to retail traders who are desperately chasing the ghosts of all-time highs. They keep the price propped up just long enough to exit the building. We saw this same psychological setup before the cracks widened in prior cycles. The market always ignores the macro rot at first. Equities will stare an energy shock right in the face and shrug. The prevailing narrative stays bulletproof right up until the exact moment credit liquidity freezes. But history is a tool to filter out your fear, not a crystal ball. So what separates today from the ghosts of past cycles? Two massive variables. First, the sheer velocity of the consumer breakdown. Historically, there's a lag. But today, the confirmed banking data shows credit card defaults and auto loan delinquencies were already spiking before WTI crude decided to march back past $100. The vice grip is tightening from both sides simultaneously. The consumer has zero buffer left. Second, capital has a new life raft. In prior macro cycles, when risk assets rolled over, capital fled to treasuries or gold. Full stop. But look at the board today. The S&P is making lower lows. Silver is dragging. But Bitcoin? It's been stubbornly printing higher highs and higher lows. It is actively demonstrating relative strength while legacy risk assets fracture. That is a fundamental change in how global liquidity behaves under pressure. We haven't seen that dynamic in previous late cycle tops. We aren't looking at these historical parallels to guess tomorrow's opening tick. We use them to understand the environment, to know that the institutional distribution phase is ending and the true repricing is about to begin. Amateurs demand certainty. Professionals trade probabilities. We don't guess what the headline will be tomorrow. We map the board, define the risk, and react when the price triggers a confirmed level. Based on the technical structures currently mapped by market strategists, we are tracking three distinct paths. Remember, these are structural forecasts based on chart data, not guaranteed outcomes. Bull case. What must happen for strength to continue? For the bulls to regain control, we need a violent deflation of energy costs. If the geopolitical gridlock unexpectedly clears and crude oil rapidly flushes back down to the $70 level, the pressure cooker vents. If that happens, watch the S&P 500 futures. The index is drifting towards 6,300, the exact midpoint of a massive, multi-year parallel channel forecasted by technical analysts. If price hits 6,300 concurrently with an oil collapse, the short sellers are going to get caught off sides. It triggers a rip your face off, short squeeze. We are talking a fast, aggressive 5% bounce. High-quality, beaten-down tech names catch an immediate bid. For Bitcoin, the bull case requires holding the line. If it defends the established trend line at $62,800, strategists forecast a reflex bounce, potentially pushing back up to the $80,000 to $85,000 range. But understand this, a 5% squeeze off 6,300 is a technical relief rally. It does not mean we are marching to new all-time highs. It is a tradable bounce inside a broader distribution cycle. Base case. What is the most likely path if conditions stabilize? The path of maximum frustration. If crude oil doesn't crash but also doesn't explode, it chops. It's currently forming an inside bar on the daily chart. In a base case scenario, oil grinds higher, perhaps testing the $110 mark. It's a classic trap, designed to get late retail buyers fully allocated just before a reversal. While oil chops, the equity market bleeds slowly. The S&P 500 hits 6,300, provides a weak, fleeting bounce, and then continues its steady migration lower. Gold catches a moderate safe haven bid, with technical forecasts pointing to a temporary bounce toward $4,650 before the momentum fades. In this scenario, we don't get a catastrophic crash. We get a slow, grinding contraction. The consumer weakens, credit defaults continue their upward trajectory, and institutional capital quietly exits the market into short-term treasuries and cash. Bear case. What would change the trend decisively? The floor gives out. The trigger here is crude oil. If WTI crude takes out the recent topping tail high at $120, the consolidation is over. The breakout is confirmed. Momentum aggressively shifts to the upside, and an energy shock is officially priced in. If oil breaks $120, the equity market liquidates. The S&P 500 slices right through the 6,300 level on heavy volume. The next major downside target forecasted by chart technicians isn't until 6,100. If that fails to hold, projections point to the bottom of the multi-year channel by late 2026 or early 2027. The metals get crushed in a dash for cash. Silver breaks its critical 64 to 66 support, plunging toward a targeted zone of $49 to $54. Gold loses its safe haven premium, rolling over to test the $3,900 level with extreme downside projections targeting $3,400 to $3,500. And Bitcoin? If true panic sets in and the $62,800 trend line snaps, its relative strength vanishes and it joins the broader liquidation. We don't predict the path, we wait for the triggers. Close the social feeds, mute the TV. It's all noise designed to harvest your attention and make you emotional. Here is the actual dashboard I'm staring at right now. First, volume at the 6,300 level on the S&P 500 futures. Price is just a billboard. Volume is the actual transaction. When we slide into that 6,300 zone, the forecasted midpoint of this macro channel, I do not care if the candle turns green. I care about the footprint behind it. Light volume on a bounce? That's just retail traders trying to catch a falling knife. They will get slaughtered. Heavy aggressive volume? That's institutional capital forcefully covering their shorts. That dictates the trade. Second, the daily chart on WTI crude. I am watching that inside bar pattern. It's a coiled spring. The market is brilliant at getting the maximum number of bulls on board right before it pulls the rug. I'm tracking the push toward $110. If it grinds up there on weak participation, it's a textbook bull trap. If it violently breaks the established $120 topping tail, we enter an entirely different, highly destructive paradigm. Third, the US dollar index, DXY, the global wrecking ball. If the dollar catches a relentless bid this week, it tells you everything you need to know. It means institutional capital is genuinely terrified. They are liquidating risk and hoarding cash. A surging dollar mathematically suffocates multinational tech earnings and suppresses commodities. Finally, the underlying inflation data. We already have the confirmed February prints showing a distinct spike. I am watching how the upcoming CPI data digests this current, sustained oil rally. If core services remain sticky while energy inputs skyrocket, the Fed is entirely paralyzed. They cannot throw a rate cut life preserver to the equity market without setting inflation on fire. I don't care what a politician says on a Sunday talk show. I care about open interest in the options market. I care about liquidity drains. Watch where the capital actually settles at the closing bell. Push back from the desk. Let the monitors go to sleep for a minute. You don't need to catch every single tick. You don't need to hold a leveraged, emotional opinion on every breaking news alert. That compulsion is exactly how this market transfers wealth from the anxious to the disciplined. If a confirmed level hits, we execute. If it doesn't, we sit on our hands. Patience is an active position. We scale in slowly. No hero trades. No going all in just because a chart looks cheap today. If the thesis is wrong, a hard stop takes us out cold. No hesitation. No ego. Protect the capital first. Grow it second. Let the underlying math do the heavy lifting while the rest of the crowd panics over the weekend headlines. This isn't investment advice. It's simply how I'm reading the market right now.